The intelligent investor begins not with a stock-picking secret, but with a crucial mindset shift. Benjamin Graham immediately draws a line in the sand between an investor and a speculator. This distinction is the bedrock of his entire philosophy. An investment operation, he says, is one that promises, upon thorough analysis, the safety of your initial capital, the principal, and a satisfactory return. Anything that does not meet these three criteria, thorough analysis, safety of principal, and adequate return, is speculation. The speculator is primarily concerned with predicting market price movements and making a profit from them. The investor, however, is focused on the underlying value of the business and treats the stock as a share in a real company. Graham then introduces us to two archetypes, the defensive investor and the enterprising or aggressive investor. He doesn't classify them by risk tolerance, but by the amount of time, interest, and effort they are willing to devote to their portfolio. The defensive investor seeks safety and freedom from bother. This investor wants a conservative, straightforward approach that requires minimal ongoing attention. For this person, Graham recommends a simple, perpetual portfolio, split between high-grade bonds and a diversified list of high-quality common stocks, perhaps in a 50-50 or 75-25 ratio, adjusted based on market conditions. The enterprising investor, on the other hand, is willing to put in significant time and effort to seek better-than-average results. Graham offers a stern warning. This path requires not just extra work, but also exceptional discipline and emotional fortitude. Merely trading more frequently or following hot tips does not make one an enterprising investor. In fact, it usually makes one a speculator. The most important concept introduced in these early chapters is the margin of safety. This is Graham's central principle of investing. It means you should only buy a security when its price is so far below its calculated intrinsic value that you are protected against substantial loss. Think of it like building a bridge designed to carry 100,000 pounds, but only allowing 10,000-pound trucks to cross it. That extra capacity is your safety margin. In investing, this margin can come from buying a diversified portfolio of strong companies at reasonable prices, or by buying undervalued assets so cheaply that even if your analysis is slightly wrong, you are still likely to do well. This principle is the investor's primary defense against the unpredictable swings of the market and the inevitable errors in their own calculations. Graham delves deeper into the practical tools and mindset required for success. He uses the concept of a portfolio policy, which is a set of rules that guides all investment decisions. For the defensive investor, this policy is simple. Maintain a fixed division between bonds and stocks, and only choose large, prominent, financially sound companies with a long history of continuous dividend payments. He explicitly warns against reaching for higher yields by lowering the quality of bonds or stocks, as this destroys the margin of safety. A fascinating and timeless chapter is dedicated to the investor and inflation. Many people believe stocks are a perfect hedge against inflation, but Graham clarifies this is not automatically true. A company must be able to pass on increased costs to its customers to maintain its profitability. Only companies with strong underlying businesses and pricing power can truly protect an investor from inflation's erosive effects. He argues that the fear of inflation should not push an investor into risky assets. A sound investment policy based on a margin of safety is the best defense in any economic climate. Perhaps the most famous character in all of finance is introduced here. Mr. Market Graham asks you to imagine that you own a $1,000 stake in a private business. You have a partner named Mr. Market. Every day he offers to either buy your share or sell you his. The catch is that Mr. Market is wildly emotional. Some days he is euphoric and offers you a very high price for your share. Other days he is deeply depressed and offers to sell you his share for a pittance. The intelligent investor's job is not to be swayed by Mr. Market's moods. Instead, you should take advantage of him. When he offers a ridiculously high price, you should sell to him. When he offers a depressingly low price, you should buy from him. But never let his daily mood swings dictate your own perception of the value of your business. This allegory perfectly encapsulates the emotional discipline required to be a successful investor. You must be businesslike and not let market fluctuations govern your logic. This section provides more detailed guidance for both types of investors and offers a stern warning about the pitfalls of modern finance. For the enterprising investor, Graham outlines specific strategies to find opportunities with a strong margin of safety. These include looking for bargain issues, stocks selling for less than their net current assets, unpopular large companies, and special situations like mergers and arbitrage. He emphasizes that success requires a systematic approach and a great deal of work. He then delivers a powerful critique of the financial industry, focusing on the misalignment of interests between investors and their advisors, brokers, and money managers. Many in the industry profit from transaction fees and commissions, which gives them an incentive to encourage frequent trading, regardless of whether it benefits the client. He also warns vehemently against trying to forecast the market. Pointing to decades of data, he shows that market timing is a fool's errand. The investor's focus should be on price and value, not on predictions. A crucial chapter is devoted to investing in investment funds, primarily mutual funds. Graham's advice here is prescient and applies perfectly to today's world of ETFs and active management. He advises investors to look for funds with low expense ratios, low portfolio turnover, meaning they trade infrequently, and a long-term, value-oriented philosophy. He is deeply skeptical of funds that charge high fees while promising to beat the market, as their costs virtually guarantee their investors will underperform over the long run. The intelligent investor chooses a simple, low-cost vehicle that aligns with their strategy, rather than chasing last year's top-performing fund. Here, Graham gets to the core of what it means to be an analyst. He makes a subtle but profound point. There is a difference between a company's reported earnings per share and its actual, tangible economic reality. Companies can use accounting techniques to smooth out earnings or present a more favorable picture. The intelligent investor must look behind the numbers. They must ask critical questions about the quality of the earnings, the strength of the balance sheet, and the company's competitive position. He introduces key financial metrics that are essential for determining a margin of safety. For bonds and preferred stocks, he focuses on earnings coverage, how many times a company's earnings exceed its interest or dividend obligations. A high coverage ratio provides a large margin of safety for a bondholder. For common stocks, he emphasizes the importance of a strong financial position, measured by a low debt-to-equity ratio and a long record of stable profitability. A company that has prospered through various business cycles is generally a safer bet than a new, untested venture. A significant portion of this analysis is dedicated to valuing a company. Graham provides various formulas and thought processes for estimating intrinsic value. While he offers specific models, his greater lesson is that valuation is not a precise mathematical exercise. It is an estimate, a range of value. The goal is not to calculate an exact number, but to establish a conservative estimate of value so that you can insist on buying at a significant discount to it. This process of fundamental analysis, scrutinizing financial statements, evaluating management, and understanding the business, is the thorough analysis required to distinguish investing from speculation. Graham now synthesizes his principles into concrete selection criteria for both defensive and enterprising investors. For the defensive investor choosing stocks, he lays out 4 simple but rigid rules. 1. Adequate size of the company. 2. A sufficiently strong financial condition. Current assets should be at least twice current liabilities. 3. A record of continuous dividend payments for at least the past 20 years. And 4. No earnings deficit in the past 10 years. While these screens might seem outdated, their spirit, to select established, financially robust, and profitable companies, is timeless. For the enterprising investor, the door is open to more opportunities, but the discipline must be even stricter. Graham discusses the potential for growth stocks, but he immediately cautions that the price paid is everything. A wonderful company can be a terrible investment if you pay too much for it. The excitement around growth often leads investors to overlook the price, destroying any margin of safety. The enterprising investor must be a contrarian, finding value in areas the market neglects or dislikes. A major theme in this section is the critical analysis of a company's reported financial results. Graham warns against placing blind faith in a single metric like earnings per share (EPS). He teaches the investor to be skeptical and to dig deeper. They should look at the trend of earnings over many years, assess the quality of those earnings, are they from ongoing operations or one-time events, and adjust for any accounting distortions. This diligent work is what separates the intelligent investor from the crowd that simply follows headlines and Wall Street recommendations. The book transitions from the what to the how. How should an investor manage their relationship with their investments and the market? Graham revisits the concept of a portfolio policy, framing it as an investor's most important responsibility. This is the supervisory function. It means having a clear written plan for your asset allocation, the stock/bond split, and sticking to it through market cycles. A key tactic for this is formula-based investing. The simplest formula is the constant ratio plan, e.g., always maintaining a 50-50 split. When stocks rise dramatically and become a larger portion of the portfolio, you sell some to buy bonds, and vice versa. This forces you to do the psychologically difficult but financially sound thing, buy low and sell high. Graham provides a powerful case study by comparing two companies, A&P, a grocery chain, and AAA Investment Corporation. During the Great Depression, A&P's stock price collapsed by over 90%. However, the company itself remained highly profitable. Investors who understood the business and recognized that the low price was Mr. Market's temporary insanity, not a reflection of the company's true worth, had an opportunity to buy a fantastic business for a tiny fraction of its value. This story embodies the margin of safety and the business-like attitude an investor must cultivate. He concludes this section by discussing the challenges and opportunities presented by the stock market's fluctuations. He acknowledges that investors will make mistakes. The margin of safety is there to protect against these errors. The goal is not perfection, but adequacy. An intelligent investment operation is one that, through a disciplined process, is very likely to succeed over the long term, and very unlikely to suffer a catastrophic loss. In the final chapters, Graham moves beyond formulas and into the overarching philosophy of the intelligent investor. The most important quality is not intellectual brilliance, but emotional discipline. The ability to control your own fears and greed is paramount. The investor's chief problem, and even his worst enemy, is likely to be himself. The constant barrage of market news and price quotes plays on these emotions, tempting you to follow the crowd. The intelligent investor must have the courage to be contrarian, to be fearful when others are greedy, and greedy only when others are fearful. The famous commentary by Warren Buffett in the revised edition underscores this point. Buffett explains that to invest successfully, you need a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. Graham's book provides the framework. The reader must supply the temperament. Graham's final message is that investing is most intelligent when it is most businesslike. You are not buying a ticker symbol that zips up and down a screen. You are buying a piece of a business. If you would not feel comfortable owning the entire business without knowing if you could immediately sell it, then you shouldn't buy a single share. This long-term, owner-oriented perspective, combined with a relentless focus on margin of safety and a disciplined strategy to take advantage of Mr. Market's moods, is the timeless essence of intelligent investing. It is a philosophy of prudence, patience, and principle that empowers the individual investor to build wealth steadily and safely